Hey everybody, do a fun little live stream. I just shot a video on WBA. So I have their 10Q up already. We can go through it. Um, we can look at another company, just throw it out there. Any ideas? You know how I do the industry comparison? Only 5 companies in this industry, pharmaceutical retailers. And of course, they're number one, and everybody else is like nothing company. There's PetMed Express, which was higher. High Tide, the cannabis company, is second, but they're tiny, tiny companies. The Quags, what's up? High Tide stock. So throw out some ideas, but I learn on these streams also when we kind of get into nitty gritty, even high level things. Sometimes I don't think about things like, oh, what's the market cap for this company or where they're located. At one point I knew it, but unless you do something consistently. So WBA 9.5 billion, not a small company, but much smaller than it used to be. I mean, it was like 50 billion at its peak. Look at the price of sales. 0.1. When the price of sales, well, let's calculate it. The P is price, stock price. So it's either the one share or you can put in the market cap. So 9.5 billion. This is 9.5 billion, the whole number. And the denominator, the bottom, is S, sales. So it's sales per share or total revenue. So 151,946, 123, 123. That's 151 billion. Let's divide it by a million. So it's easier to see. And then the calculation is P over S. So it's actually 0.06. It's rounded to 0.1. But that it does give you a little more information because 0.06 is better than 0.1. Because say, for instance, it went up from 9.5 billion to 12 billion. Okay, that brings it up from 0.06 to 0.08, but both situations is 0.1. So let's just pretend it went to see, it's a pretty wide range. Okay, look at this. Look how wide a range this is. So it's currently 9.5 billion. That's their market cap, and their revenue is 151 billion. So it's 0.06, which rounds to 0.1. Let's just say the stock price doubled. That's a big deal. It more than doubled. It went to 20.9 billion. It's the same exact when you round it because it only goes out one decimal. Hey, Chris, what's up? But that's a big difference, right? 9.5 billion and 21 billion. I mean, that's like 100. Let's see the percentage. A 120% increase in stock price. Same exact price of sales. Because the bottom, the sales doesn't change. Each quarter it changes. But if a month from now, their market cap went up 120%, their sales won't change. It changes every 3 months. So it might be 2+ months with no change. So that's a big deal between 0.06 and 0.14. And I say on my videos that when the price sales is below 0.1, two things that are likely to occur, and they're both on the extreme sides of the spectrum. One is really good value, like it's extremely undervalued, and it's a great deal, which is pretty extreme, right? It's pretty a bullish extreme. It's really, really well valued, or they're headed towards bankruptcy, and it is that extreme. Like you go from one extreme to another. How could it be so different? Well, when it's the lower the price of sales, the better the deal, right? But why does it get so low? And the reason it gets so low is because the market cap keeps getting pushed lower and lower and lower. And if you ever noticed a company that ends up going bankrupt, if you look at their market cap 1 or 2 years before bankruptcy, it came down dramatically, right? And it kept coming down. The reason it keeps coming down is because people are not willing to buy the stock. So what do you think in this situation? I think it's a really good value. I don't think they're going bankrupt. It's just 151 billion market cap. That must be the top 50 in the world. I don't think it's top 20. So the largest revenue in the world is Walmart, almost 700 billion. Amazon's going to beat them eventually. So it's not okay. It's pretty close to the top 50 because look at 50, 147 billion. And I think this revenue is as of 2023. So it's pretty close to top 50 companies. Let's see if we can find it on the chart. What's up, 207? Here we go, 41. So in terms of revenue, if you rank all the companies in the entire world, they're 41st. Because this takes into account private companies, not just all public. I think so. Actually, we don't really know the revenue for a lot of private companies. But if you're private, you're not north of 100 billion revenue. Saudi Aramco was private. Now I think 10% of the company is publicly traded. So we do have that information. How many companies? Let's just do in the US. How many companies in the US do you think there are? Probably like 100,000. Well, 133 million. I didn't expect it to be that high. That's how many companies in the United States. So what are they, 41? So 33 million. Let's just lower it to 30 million. It's kind of high. So this is how many companies are above them in terms of market cap. 0.0001% of all companies are above them. So they're in the top 99.99 percentile revenue. Doesn't mean they can't go bankrupt. Because companies have gone, Enron went bankrupt and they had a really big market cap, but that was kind of a shady thing going on. Like they cooked the books. If we are assuming these 33 million companies, for the most part, are legit, they're not running a Ponzi scheme. Will USA continue to be the largest consumer of the world? I mean, I don't see why it wouldn't. Gross domestic product. I mean, the gap is closing, and I think that's a good thing. I don't see. It's kind of like as we grow as a country, right? Do you think, like Canada, Mexico, all border countries, or do you think any in Europe? Do you think that they're upset that we're growing, consuming? Maybe they're a little jealous, but it can only benefit other people. Like if my neighbor, comes into a lot of money, wins millions of dollars, it can't really hurt me. I mean, it could benefit me because what if they do something with the money? They open a business, and that business helps the revenue for the town. It helps bring in taxes. It gives jobs. So it can only help. I mean, people get jealous, things like that. But in terms of the benefit, there's no real setback if people in your community start generating more money. It can only help. The world depends on the US. It does. Because it's kind of like if you live, and you would know this if you live in a small town, but say you lived in a town of 5,000 people. Walmart is a good example of this. What town in Bentonville? What's the population of Bentonville? 15,000 people. Oh no, that's Walmart's headquarters. Population Bentonville. 59,000 people in Bentonville. Do you think they're upset that Walmart's there? That pretty much employs the town, or a majority of it. No, I mean, maybe some neighboring towns are upset and jealous, but of course they're happy. You have this big company that's giving all these jobs out to people. And that's what you want if you live in a community. You want a company to employ people. If it doesn't employ you, if you live in Bentonville and you're not employed by Walmart, somebody is. Like it's probably, but that's pretty extreme to have one company employ a town. But they employ more people than the entire town of Bentonville. I mean, because they have stores all over. Most companies aren't that massive. They can employ an entire city or county. They are. But yeah, I want to see the GDP by country historically, because the gap is coming in. Because China, moved up pretty quickly. Uh, GDP, which is great because they're our biggest debt holder. They funded the most debt of any country, and that's helpful. That's really helpful for us to maintain jobs. Hey, Daryl, is it Daryl or Darrell? Um, this looks like it gives the first Daryl. Okay. Okay, this is percent of world's GDP. Okay, so obviously in the year one, we weren't controlling the world because there was no United States. We're actually in terms of countries, if you look at countries around the world, we're actually a young country. A lot of countries have been around much longer than us. So in terms of age, like if you're going to say, like, India is like your great great grandfather who's 100 years old, but we're like teenagers in terms of, on a scale. If you're going to compare, we're like a teen in terms of age of country. We're young. We haven't fully developed yet. We're not babies. There's some countries that are babies, but most countries are much much older than us. So obviously we didn't control anything in the year one. I don't even know how they figured out this chart. It's a total guesswork to know countries back in year one, but let's just assume it's correct. So we were zero until obviously we became country in the 1700s, and even then it took until the 1950s to start controlling everything. And we had more GDP than Western Europe at one point, but I mean, Western Europe is many countries. So now according to this chart, we're equal to China. I don't know how they get these numbers, but we're probably a little more than China, not equal. Albertsons merger with Kroger is good. I mean, I think generally a merger is a good thing. Generally, it's kind of like if obviously it doesn't always work out. It's kind of like if you're single, is being married a good thing? I mean, you have to weigh the pros and cons. You have a partner, you have some stability, and then dual income, right? Even if one person makes 100,000, another person makes 50,000, now you're an entity with 150. I want to see something actual countries. I was hoping to see, not okay. The following estimates are taken from the monograph. Okay, it's GDP. So this is the forecast. This is interesting. So right now, well, it's 2003, so it's a little stale, but GDP for America is 8.4 trillion, China 6.2 trillion, then Japan. The projection by 2030 is China takes over, which I think there's nothing wrong with that. 23 trillion, and then we go to second at 17 trillion. But it can only benefit us, like I said earlier, if you have other countries or neighbors of yours who are doing well financially. It can't really hurt you. They're not going to invest money to like screw your business up. but there's a chance they grow, because if we in the US, if a company is doing well, like a McDonald's or Starbucks, you could you could only grow so much in one place. US is big, but not every city works for every store. So a lot of US companies expand to other countries. And do you think those countries are happy? Of course they're happy. They get jobs, they get tax revenue. So the more Chinese company grows, and there's a lot of examples of this, there's a lot of Chinese companies that expand to the US because companies want to expand to the US. Because right now we have the most money, the most disposable income. Apparently China will in 2030, but any country in the top 10 is a good opportunity to expand to. So yeah, let me know if you want to talk about anything in particular. I think it's just interesting going through these financials and digging a little deeper into it. So why is WBA, why are they going down so much? Why, like, the stock price is almost at a 30-year low. I'll show you right here. So it's about $11 today. I think almost exactly $11 today. And it actually didn't hit 11. It didn't even touch 11 in the Great Recession in 2008. It didn't even touch 11 during the dot-com crash in 2001. You'd have to go back to 97, 28 years ago, to get to that level. So if you looked at the company 28 years ago and you looked at their revenue, their profits, do you think it's better now? Of course. Now they're $150 billion revenue company. But why does it keep going down? Well, investors don't think the future looks good. That's pretty much the only reason the stock goes down. If people thought the company had a good future, they would buy the stock and push the market cap, the stock price, past where it should be. Where's the so here's the revenue for the past. You could, even in 2014, there was 75 billion of revenue, which was probably still a top 20, top 30 company, but it's grown. It's not like it's gone down. It's up to 150 billion. It doubled. Granted, it hasn't grown much since 2019. It's averaging like a 3-4% growth annual. I thought WBA retail had a rough time. Well, yeah, profits are down. That's why their stocks go down too, is that they're losing money, or they're not really making much anymore. I think theft is part of it, but I think the main reason is it's more expensive. Because when you're a retail store, you have to buy products and sell the products. It's getting more expensive to buy products, and you're selling the products for more, but you're not as much more. I have a stock. That did a repayment of capital a few times. Do you think that's a good way for a company to correct for their stock being undervalued? A repayment of capital. What does that mean? You mean a stock buyback? A repayment of capital? Or do you mean like paying down debt? Well, if a company does a stock buyback, it's considered a good thing. Most people like it because Because if you have if the market cap, say, is 200, you could say that's millions or billions. And there's 200 shares. So what's the price? $1. $1 per share. But let's say they buy back stock. So market cap, just pretend it doesn't change. It's still 200. It probably would change, but and they bought back 10% of their shares, a big buyback. So that's 20. So now they have 90% left over. So it has to go up, right? That's why people logically think buybacks are good, because shares go down. Usually the stock price would go down, because how do you buy stock? With cash. So your balance sheet gets worse in a sense, right? It actually doesn't change anything on the balance sheet, because depends how you got the cash. But whether you took on debt to get the cash or used it from your residual income, it does lower your cash. In the long term, it's generally considered a good thing. How come Berkshire doesn't just buy back? What do they have? 350 billion? Why don't they buy back like 10% of the company? Because Buffett thinks he could do more with the money than just leaving it, buying back his own stock. Of course, if his stock price gets lower, it would become more appealing to buy it back. 200 million, strong Brazil. 220 million, strong Brazil could be a place of growth. Oh, they sold parts of the company and paid it to the shareholders as dividend. Well, I mean, generally you can't grow when you sell your company. That it's not a long-term play to sell off business units. But if there's part of the company that's not profitable, or if it's profitable but not nearly as profitable as those other parts, you have to just when a company makes a decision like that, you have to assume, or at least hope, that it turns into a good long-term play for the shareholders. And that's pretty much every decision, is to provide a return, or a better return to the shareholders. So you have to kind of look at it from that point of view, and only time will tell if that does happen. What? How come it's not clear? Maybe I gotta update my glasses. What asset do you think cost the least to borrow? What asset cost the least to borrow? I'm not sure. But that's kind of like theoretical, I'm saying. We could look at it like an actual situation and then kind of talk about it. And that's how you do like investing. Like you look at situations like, oh, this company acquired this company. I think that's good, or I don't think it's good. I am a sucker for buying sell-offs. I bought units this past. Well, what stock are you talking about? Sell-offs. You generally want look. You want to look at the big picture of a stock and understand the company. But here, let's dig into their financials. Unless somebody else, if you donate like $5 or more, I'm happy to like do a deep dive into any stock. But or just say it. Like you don't have to always donate. I'll look at most stocks, but anyways, so this is kind of like how I do my due diligence. So this is the most current quarter for Walgreens Boots Alliance, 39 billion of revenue, just for the quarter, which I think that is their highest quarter ever, or it's pretty close to the highest quarter ever. Last year, the same exact time frame in 2024, 37 billion. It was a leap year 2024, so that's why the date is different, but it's the same 3-month block. And that's how you kind of compare companies. You want to compare it to the same time frame last year. I'm not saying it's bad to compare it to last quarter. I'm saying generally quarters can be lumpy. Lots of companies have higher revenue in the fourth quarter due to the holidays, or maybe certain expenses only come through if they're annual. So US improved. Last half, what's up? How's it going? So US went up in all their categories. Pharmacy went from 21.5 to 23.4. That's a pretty good increase. 21.5, 23.4. It doesn't sound like a huge increase, but if you actually look at it, percentage-wise, that's pretty good. 9%. A company of this size, and they're not a technology company, anything north of 5% is good. It's hard to grow. That's almost 10%. So once you get close to double digits, you're doing something well. Because you have to grow with inflation, hopefully a little more, but obviously this crushed inflation, 9%. 3 years ago, inflation was probably close to 9%, but and then retail actually went down. So retail, because the way I think about a store like this is that they have a brick and mortar location, and if in the front of the store you can buy snacks, candy bars, maybe scratch off tickets, you can buy shampoo, a lot of things. The store is kind of big, but in the front half or most of the store, it's you're buying stuff, convenience items. So that's their retail. In the very back of the store is the pharmacy section. So if you get a prescription or you want to get like certain medicines, you go to the pharmacy, and that's where a bulk of their business is. Pharmacy in the back of the store. So it still went up, 28.9, 30.3. Nearly 5%. So it's beating inflation by a little bit. So actually, I drank too much water. I'll be right back. Gotta run. Okay, yeah, thanks a lot. So they reinstated their dividend. Who reinstated? Are you talking about? Are we talking about WBA, Walgreens Boots Alliance? They cut their dividend. Yeah, I'll show you. They cut it. I don't think it was in half, but they cut their dividend. So here's the dividend payment. They pay a quarterly dividend, and they've probably been paying a dividend since before most of the people were born on this stream. So it was 33 cents or 34 cents around it in 2015, and it only goes up. So every year, I think in August is their I think their fiscal year ends 8/31. So every year they raise it. 30 36 to 37 to 40, 44 in 2018, 46 in 2019, 47 in 2020, 48, I'm rounding it to 2021. And I think they kept it flat. Well, it's 0.477 cents in 2021. Oh, they did raise it from 0.477 to 0.48. So they raised it less than a penny, like a third of a penny. But they raised it. But it was 48 cents in November 2023, and it was almost cut in half. Not quite. So they cut it 48%, from 48 cents to 25 cents. So they cut it 23 cents, a 47%, 47.9% cut in the dividend. And that was in February 2024. So look at this. In November 2023, their dividend yield was 8.6%. You know, who has an 8% dividend? They cut their dividend payment by 48%, so the yield went down to 4.8%. But it shot up to over 10%. So now it's over 10%. This is their forecasted dividend of 2.3%. But now it's actually 9%. I mean, this is as of November 2024, 10.4%. Now it's 9% because I think the stock actually went up. And the only reason it went, they cut their dividend pretty much in half, right? And the yield is higher. Because the stock price came down more than the dividend yield came down. So it's probably around here is just the calculated dividend. So it was over $10 a share in the beginning of this year. And what's it at now? Now it's 11. No, it's back here. What am I doing? November 2024. I was looking at November 2025. So it was almost $20 a share when they cut their dividend. And ever since they cut it, the stock is down like 50%. You could have got it for $8. It's still $11. It's still, wow, it was $8. Rather go with Walmart. Yeah, I don't think this is a sure bet, but I think the risk is there. You have to, it's risk reward, right? So when was it $8? In 96. So 29 years ago. Um, it's kind of like, here's a simplified approach to what I mean. The risk reward and percent reward. Let me see if I could mathematically show you what I'm talking about. So let's just use WBA. So the risk is, it's I don't think it's going to go to zero. Let's say the a main risk of, say, investing in the stock. Say we look, this is our 1 year projection, what we think is going to happen. So that's the risk. I mean, that's what you think is a risk. In 1 year, it's going to go down 30%. That's your estimate in like a bad scenario, because it's already down a lot. Reward, up 150%. And what's the chance of that happening? So if you think it's 50-50, you take the product of these two scenarios, and it's positive 60%. So if you put $100 into the stock, you would have 160 a year from now. How does that make sense? Well, I mean, it's all estimates, right? Who knows if this could actually come true? But you think it's kind of a coin flip that the stock will either go down. Of course, it could just stay flat. But that's because it's a 50-50% scenario. If you thought there's a 90% chance of it going down 30%, which may be more likely, and it's conservative to do this, and a 10% chance of it going up 150%, then you'd have to take the product of these two still, and now you're at a negative 12%. So you would not invest in this stock. This is just really simplified way to do it, but there could be multiple scenarios. I don't know if you guys have done any stats classes before, but sometimes there's like 3, 4, 5 scenarios, and then maybe there's a likely scenario, which is like maybe 60% chance of happening, the unlikely. So this may be the likely. I think they call it base case, something like that. This is the unlikely, and this is, so you kind of like it. Sorry, like you take the two extremes and then you take a middle. Okay. Walgreens never adapted to e-commerce. The retail expenses are there. Insurance, right. They didn't. You have Walmart, which is the number one brick and mortar retailer. And then Amazon is just Walmart online, right? And they're the number one, e-commerce. So they just pretty much took Walmart's, because Walmart says everything. So does Amazon, but they just put it online. And now Amazon is obviously a lot better and bigger. And you seem like you are picking up cigar butts with WBA. So you're saying you're kind of picking up trash, or you're a bottom feeder. Well, I didn't buy it, but I'm just trying to show you a scenario. Um, it seems like it's a good. It seems like it's a good one, but I'm not sure. CVS may be a better deal, actually, which is similar to Walmart. That's another. So that has been coming up from the bottom. What it bottomed out in the low 40s in December. So that's actually up. And yeah, in December it got real low to the 40s. Oh, a Warren Buffett expression. Okay. Yeah. But I think it's a good exercise to kind of like just showing you a way to do like due diligence, like the process. And I learn too when I do stuff like this. Um but what else? Is there other stocks? Um it's hard to like really you know, sometimes you do all this due diligence, and even if you're right, it's like if you have to wait like a year or two, or imagine 5 or 6 years, it's just so hard to like sit and wait. Like we want like results. So if after a few months your stock isn't going up, you're like, I'm wasting my money. So you try to invest something else. Oh, SEP. Yeah. But I'm with you. Like I made lots of bad decisions. It's hard to yeah, it's I mean, you always look back. Cantor. Is this Cantor Fitzgerald? What's the portfolio? I want to see what's in this. Um, it'd be good if this looks like a mutual fund, right? Uh, they own stock, or is this SPAC? What type of company is this? My hard decision is to know when to sell. I know it's so obvious after the fact, but when you're living it, it's this is a SPAC. Okay, so it went from 10 to 30. So who did they acquire? Cantor Fitzgerald. It's a SPAC now. Going to acquire. What do you mean it's going to acquire Bitcoin? You mean a company that invests in Bitcoin? I don't think I read about this. This is why it's good to do these streams. I learn or sometimes I learned something, but you don't like, you only read it once, so you don't remember, and then it jiggers the memory. So Cantor stocks. Do you remember Cantor Fitzgerald? They lost the most people on 9/11 because they had like the top 13 floors in like one of the World Trade Centers. So they lost like, I think it was like 800 employees. I mean, it's really sad. And the CEO really stepped up, like big time. Like he visited the families. He he promised that he would employ. Like they had, like some of the people who died had kids, sometimes babies, and he promised he would employ. And now he he has working for him some of the babies whose mother or father died in 9/11, now working at Cantor Fitzgerald. He gave a lot of money. He went really above and beyond because he felt really awful because he wasn't. He I think he had to drop his daughter off to like school, like elementary school, something like that. So he wasn't in the towers when it collapsed, and he really had like a lot of like what's that term, survivor guilt. I mean, it's nice. It's a really nice because when you make a lot of money, I'll never know what it's like to make $100 million a year, but when you make a lot of money, you realize how it's not so important. When you're starving to death or struggling, money's so important. But once you hit a certain threshold, like you're able to cover your basic needs and necessities, each dollar doesn't like bring you that much more joy. I mean, like if you're in the U.S. and you make $20,000, every like $10,000, like the happiness and joy goes up dramatically. But once you hit like a certain number, like 100 and maybe 50,000, depending on where you live, like going from like 150 to 200 or 200 to 250, or like it doesn't like bring you that much immense joy. Everybody wants to make more money. Um, what's his name? Howard Lutnick. Yeah, I can't remember the article that talks about this, but I thought it's pretty interesting. Okay, Cantor skyrockets 130%. Bitcoin SPAC market cap still trails intrinsic BTC exposure with 21 set to control. So they're going to buy 42,000 Bitcoin with this SPAC. Post convert ownership heavily favors insiders with public shares. Shares of CEP surged. It's a Bitcoin play. So, I mean, people say, why don't you just buy Bitcoin? Like, why are you buying this? It's a different I'm trying to understand exactly what type of company they're acquiring. Are they just acquiring a company that owns 42,000 Bitcoin, led by Strike CEO Jack Mallers and Brandon Lutnick? 21 Capital is being positioned as a public proxy for Bitcoin, potentially holding 42,000 BTC. According to the last pro forma, ownership. Tether will control 42.8% of equity in 51, and Bitfinex and SoftBank hold 16% and 24%. So what's the name of the company they're acquiring? Is it 21 Capital? Is that the name of the entity? Maslow's hierarchy of needs. If a well, you know what a SPAC is? It's a SPAC is it's a publicly traded shell company. It doesn't do anything. It has no business. It has no plans to operate a business. The only thing it does is acquire a private company. People invest in a SPAC hoping, because they pay $10 a share, even though it's not doing anything. And I think they have up to 2 years to acquire a private company. If they don't, then they have to return the money back to the shareholders. So they look around for a private company, and there's been hundreds of these things done. And then that's what the new company, that's what the SPAC does. They change their ticker to coincide with the company they acquire, and it becomes a publicly traded entity. So this private company goes from private to public once they get acquired by a SPAC. It's the same thing if you have a small business, right? And your small business gets acquired by Microsoft. Your business becomes publicly traded. It gets rolled up into Microsoft. And it's only a little tiny speck of Microsoft, but this SPAC, when a SPAC acquires a company, then the new company becomes that private company becomes a new company, the entire company. Yeah, so I'm saying, so if you find out about a company that is acquiring a SPAC that's acquiring a private company, I'd say a good thing to do is research that company, because obviously there's going to be a lot of information on the SPAC's going to provide you a lot of information about that company, but it'd be good to see how that company performed before. Maybe there's reviews online before anybody knew about the SPAC. 21 Capital. Let's see what it says about Tether, SoftBank Group, and Jack Muller's launch. So Tether is part of the team to launch this. 21, a Bitcoin native company through a business combination with Cantor Equity Partners. So I think this entity 21, I don't think is even a business until Cantor's SPAC acquires it, which is, and you correct me if I'm wrong, but when a SPAC acquires, like for example, okay, largest SPACs. So who's like a kind of well-known SPAC company that's succeeding? Is Coinbase a SPAC? There's one. The first SPAC was in 2009. It really took off in 2020. The 59 in 2019. 2021 was the peak of SPACs. 2024, wow, only 8 SPACs? I think it's mostly garbage companies. Yeah, but what company like DraftKings? Okay, that's a good example. In 2020, they were acquired by a SPAC. So DraftKings is what it started out as a private business um, for people who wanted to gamble online. I think it's mostly sports gambling, but I think there might be other. But yeah, so if you wanted to gamble on sports, horse races, you go to DraftKings. So they were in 2012. They started and they were operating, day in day out as a regular company, and then they got acquired in 2020. Acquired in 2020. That's generally how it works. A SPAC, a shell looks for a private company, uh, and they look at their financials. They try to determine if it's a good company to go public. They want to, they want to make money. They're going to make money in the underwriting process, but I think they probably make more money since they own equity. And then, obviously, if DraftKings starts, putting up better numbers, they acquire more businesses, revenue goes up, then the stock goes up, right? But in this case, it's I don't even think 21's a company. Last half, thank you. Appreciate it. I think it's just an idea. And then and Cantor Fitzgerald is part of that. Like, you see what I'm saying? Like, most private companies that get acquired have been operating many years as companies. This is not even operating; it's just an idea. And Cantor Fitzgerald is part of that process. Sounds pretty shady to me. Um, I wouldn't trust a SPAC. ECT. ECT. What is that? Is that a stock? Did you mean to type in EC? Oh, did you want me to look at a stock last half? That's why I thought you donated 5. Is there a stock you want to talk more about? Oracle, Arista. How about a look at Yala? Yala. Arista. It's a good company. I do like Arista as a value play, 78.95. It's pretty simple to do a DCF. It's predicting future free cash flows and discounting it back to today's dollars. I mean, you could get really technical, but this is a simplified way to do it. Um, there's more than one way to skin a cat. So you can see free cash flow is 3.7 billion for 2024. The forecast is 4.8. So let's say 3.7. Let's just use the actual estimates, and then of course we could change it. So it does seem overvalued, slightly overvalued. They're trading at 78. I'm at 67. But the thing is, some stocks, they remain overvalued for like 10, 20 years. It was like Tesla. It was, everybody kept saying, I kept saying how overvalued it is, but people made a lot of money if they sold. The problem is a lot of people went down with the ship. I mean, it didn't come down, but it came down a lot from the peak. Hey, Yahoo Finance takes so long. So that could be an AI play, Arista Networks. They're the largest company in their industry. And they're not in an industry with small companies. How come it doesn't list the name of the industry? So they're in, oh. They're in the industry computer hardware. So definitely not an industry that's, you have a lot of these little tiny companies, little small companies, pretty big companies. So they're the largest company in that industry. 95 billion market cap. It's a pretty sizable company. You can see, you can see the massive run up. It's a young company, fairly young, 2014 it started trading. So it did peak this year. So lots of companies peaked in 2021, right post COVID rush. This peaked this year at 129, and it got cut in half, 50%. That's a big drop. So 129 to 64. 64 was 2 weeks ago. It's up quite a bit from the bottom. If you're a bottom feeder, obviously, how would you know 64 was the bottom? But if you put a buy order in for, say, 69, say your goal was under 70, you probably got a great discount. Software companies are really scalable. Let's see the insider trading. I like seeing this when the CEO has been with the company a long time, 16 and a half years. I hate seeing CEO at the company for 3 years, 4 years, 2 years. It should provide you a little more comfort seeing that. Like if I was like bullish, bearish signs, I would put that as a bullish sign. And I also like seeing this, the CEO not making that much money. For a CEO to make 300K at a $100 billion company. Of course, his compensation is going to be higher because he has options and it's usually stock related. So he does get a bonus too, based on how the company does. I think if I was CEO, I know it's easy to say now, I probably wouldn't take a salary or a dollar salary like Zuckerberg does. And my whole salary is based on the company's performance. That's kind of like if you own a small business, you're pretty much, you don't get a salary. I mean, you may actually take a salary each week, but in the end, if the company loses money, you have to eat that, and it comes out of your salary. And if the company makes a lot of money, you benefit. So there's cells by the same person. Kenneth Duda, co-founder. So he sold, well, that was a good sell, 119 a share. Like the peak, I think, is 124. So he probably wishes he sold everything then. He could have sold at 119 and bought back. Instead, he just kept selling. He sold at 119, then 86, then 70. Of course, after the fact, we can look at this, but when he's actually selling it, he's not like planning, okay, I'm not going to sell today, I'll wait 6 months, or I'm going to buy and then sell later. He could be retiring, I don't know. 69% held by institutions, 18% by insiders, 13% by the general public, and the government owns 0.1%. Andreas Beckloshheim. He's probably the founder CEO. He's obviously on the board because he's the biggest shareholder. So he started the company in 2005 and then changed that company's name to Arista. He left Sun Microsystems to become the chairman and chief development officer of Arista in 2008. Oh yeah, good point. Last half. Quarterly options. He might have been locked in. But I don't know if you worked at a company. When I worked at JP Morgan Chase, it was such a good deal. There was the employee stock plan. So what they did, say it was the first quarter was just complete. So 1-1, and say I put in $4,000. So every quarter I buy 1,000 of stock. So let's just say each share price on 1-1. This is how they do it, or at least JP Morgan did it. Say each share is $25, and on 1-1, and let's say on 3/31, it's 32. So they give you $1,000 worth of stock at the lower of the two. So in this case, I would get 40 shares of stock because I would pay $25 per share. And I could, at least that's what that guy did, immediately sell it for 32 because that's what it's trading at. So I could take those 40 shares and immediately sell it, and I make $200, $280 of profit. So you can't even lose with this scenario. Like say it was 25 on January 1st, but it went down. to 23. So then they would give me 1,000 shares, $1,000 at $23 a share. So I would get the lower of the two. So I would have 43 shares. I mean, I could immediately sell it, but I wouldn't be profiting. If I needed the money, I could sell it. But this would be really good, like if the stock went up a ton in the quarter. Like it went, imagine it was like Nvidia, went from 25 to 125. I'd make a $4,000 profit. I would get $5,000 of stock for $1,000, and then I could just sell it for 4,000. I mean, then I could sell 5,000, so I profited 4,000 because I initially paid 1,000 to get it. Does anybody have this plan? I wonder if it's the same at other companies. I think they probably have their own like rules. Each company, I guess, is really up to them. So BlackRock, Fidelity, State Street. So a lot of big funds, big banks. Another bullish sign, because if you see, a Fidelity, a BlackRock owning the stock, it should give you a little more comfort. That if they're buying it for their funds, chances are it could be a good investment because they have people doing research. So that's what you kind of bank on. I'm not saying you only should buy if these big companies own it, but it's just another thing to look at. Lots of employees. I mean, lots of growth. Went from 1,000 to 4,400. And it's trading in multiple exchanges. The word is they make a superior product, maybe like for 25% or 40%. Yeah, I never really looked into them too closely of their products. Let's they sell data-driven client-to-cloud networking solutions for AI, data centers, campus, and routing environments all around the world. So it has a cloud networking product, data centers. I wonder if they do a lot of business with the government. It also provides post-contract customer support. So that's another revenue generator, is when you not only sell a product, how I have Microsoft Excel, Word, but I think pay like $100 a year. So I get the updated ones, or I can get customer support. The services, help with bug fixes, upgrades, etc. So you can see what kind of companies they sell to: internet companies, cloud service providers, financial service organizations, governments. That's what question. Honeywell and Dover Corp are down well. Honeywell. That's Honeywell. Actually, I'll be right back. 1 minute. So Honeywell, it's like a it's like a well, right? That pumps out honey, and they sell the honey to grocery stores. 129, what 200. Um, let's look at the future free cash flow. It is down. It's down a little bit. It's 5 billion. It was 5.6 billion. So it's at a pretty good level. Some from 5 to 7, that's the projection. This seems overvalued also. I guess the well of honey, maybe it's not as profitable. People don't want honey. They want other sugary things to add to their tea besides honey. So obviously I was joking. So they're an aerospace technology company, industrial automation, building automation, and energy and sustainable solutions in the US and around the world. So they definitely work with the government. So in their aerospace division, it offers propulsion engines, integrated avionics. So it's good to understand this stuff on a high level to just see what they sell. Because you'd want a company that sells a product that is kind of valuable or needed. Because if the product is kind of obsolete or getting to that point, it kind of doesn't mean you can't make money, but just a little harder. And obviously they sell things other people sell, but you want them to do it better or at least more efficiently. So they've been around a long time, 1906. But the predecessor companies are usually something totally different. So 1885, this person, Albert Butz, invented a thermostat to control coal furnaces, bringing automated heating system regulations to homes, blah, blah. Yeah, it's just interesting to read about it. You're not going to really learn, oh, okay, now I can invest in the company because Albert Butz invented this product. But it's good to see how they, for a company to be around over 100 years and to grow to this level, they obviously do a lot of M&As. Honeywell has a quantum AI business, not widely known. Yeah, that can help you do your due diligence if you do a little more digging, and if you think the business they're working on, kind of like Tesla with their autonomous cars, like it's a great thing, a great idea. It can make the company really profitable. The problem is they haven't done it yet, and even if they do it, you have to look, are they going to be profitable? I think they will be, but they have a lot of competition with Google's Waymo. So in 2019, Go Direct Trade launched an online marketplace for surplus aircraft parts. In 2020, Honeywell announced that its quantum computer is based on trapped ions, which obviously I have no idea what that means. Its expected quantum volume is at least 64, which Honeywell CEO called Quantum. Hmm. Quantum. Does that have its own ticker? That's a private company. Quantum is a quantum computing company formed. So it's not it's a separate entity, a private company that's separate. Yeah, it that happens. It freezes for like 5 seconds, and then it comes back. It should be back by now. If it's not back, just refresh your computer. Let's see. So Simply Wall Street's at 203. So pretty much where they're trading at. Let's see. 23 analysts at 229, so they say it's a bit undervalued. Revenue is projected to continue climbing. Hopefully, it climbs more than this. If you're investing, you want to see double-digit growth, not like 6-7% growth. Revenue is pretty flat. 2014 was 40 billion, and now it's so that's not good. That could be why maybe the stock price hasn't moved so much. It's actually done well. So it pretty much only goes up, not many pullbacks. The peak was end of 2021. Lots of companies peaked at the end of 2021. And it kind of traded sideways. It did come down, but right back up almost to its all-time high. Or no, it did break its all-time high in December. And it has come down. The market as a whole has come down. So it's been trading pretty close to 200 for the past month. You could have got it for 180 on April 8th. So, I mean, the market crashed that day. So lots of deals. Some stocks went down, like big stocks went down 10 to 15% that day. So this was one of those stocks. So what's the dividend like? They seem like a company that would not cut their dividend. So pretty much every year they raise their dividend. And companies like to say this. They like to say, this is the 20th consecutive year we're raising our dividend. And they raise it like 52 cents to 60 cents. It's a pretty big raise, like 15%. So they do raise it quite a bit. Let's see, 82 to 90, so 10%. I guess they're more and more profitable. Imagine getting it like in 2015, your yield would be like 30%, 40%. Their yield is pretty steady because they do raise their dividend a lot, but it's because the stock it's because they're making a lot of money and the stock goes up a lot. So it kind of moves with the dividend. CEO makes a lot of money, 900,000 up to 1.6 million dollars. CEO tenure 2 years, $18 million compensation. Both, especially the 2 years, is a negative sign. 84% held by institutions, 16% by the general public. And these are the biggest shareholders: Vanguard, BlackRock, yada, yada, yada. Okay, so big funds, nothing out of the ordinary. Sometimes when you see half the companies owned by like a foreign country, especially certain countries, people stay away from those stocks. Because if 80% of the company's owned by Saudi Arabia, then that country kind of controls the stock. It's really, they can do what they make the decisions. Employee count is down. So that's, I guess, cutting expenses. But why is it down so much? And of course, it's traded all over the world. So, there's the quantitative due diligence, which is like doing the DCF, and then a qualitative, which is just looking at the numbers. This is what I did a week ago or so. I was looking at how the bigger stocks have done against the S&P 500. I can't believe Berkshire is up 12%. That's why my Berkshire is my biggest gain percentage-wise. I was a little concerned because one A share is expensive, and I was like, for a while, I in 2017, I bought Berkshire. Same thing with Spiders, and for a while, Spiders was beating Berkshire for like 3-4 years, and I was like, I should have just invested, put more into the S&P index. Why did I try to like go out and do something? I mean, it's not risky, Berkshire, but I guess it's more risky than S&P 500. But now Berkshire is up 200%, so now I'm happy. Hopefully, it continues growing. But there's never going to be a point when you're like, oh, okay, it's a good value, because I paid $262,000, which is a lot, obviously, for one share. But like, at what point is like, it's always going to be a lot. So you can't wait forever. Saudi's own Lucid, right? Lucid. Lucid makes what's that drug? Lucid makes ketamine because it makes you lucid in your mind, right? Lucid definition. They make ketamine drugs. So your BRK is a VIX or hedge against recession. I don't know. I mean, it's not like buying gold. They do own a lot of oil-related stocks and kind of like commodity type stocks. He doesn't really own much gold stocks. He owns railroads, telecommunications companies. I mean, for a while, it was half of the company was Apple. I mean, he sold a lot of his Apple. So Lucid is 58% owned by the Public Investment Fund. So Public Investment Fund is the is like the Saudi government. It's a sovereign wealth fund, almost $1 trillion fund. So so people who live in Saudi Arabia invest in this fund, and the fund invest in companies, just like a mutual fund or ETF. And I wonder how much. I wonder if it's mostly U.S. stocks, or more than 60% of the fund's activities are okay. So 60% of the money is within Saudi Arabia, because if people are investing in this fund, they want to support their country. Generally, that's what you want. That's why you buy muni bonds, to support your community. Within Saudi Arabia, the fund's investments primarily go to private conglomerates owned by prominent business families. So it's not like it's going to fix the roads in the town. That's for the government. This is just an investment vehicle, and the funds are used to make more money, to be profitable. You give a ROI to your investors. Outside Saudi Arabia, the fund's investments into prominent foreign assets such as Premier League football club, Newcastle United. So you can see there's been conflict with the fund. It's generated controversy due to the fund's lack of transparency. So you don't really know where the money's going. And it's close control by the Saudi government, which has itself faced significant criticism around the lack of human rights in the country. Yeah, BRK owns 5% of bonds. Yeah, that makes sense. I mean, they have 330 billion of cash, so that alone is 20% of the company, right? Because it's what is it, like 1.3 trillion market cap? Maybe not that high. God, it's so slow. I hate Yahoo Finance. 1.1 trillion. Yeah, 1.1 trillion. Okay, well, only 8 people. Anything else? Any other stocks? I can't believe it's up 31% in the past year, Berkshire. It's really amazing. Because when a stock is up 31%, you don't know if that's good or bad. Because if you look at the S&P 500, it was up 50%, then it's actually down. But if you look at the S&P 500, and the S&P 500 is down 5%, it's actually up 36%. And that's generally what happens with Berkshire's portfolio. It's usually it usually does well or not as bad during bad times. It doesn't always go up as much. Like the S&P 500 was up 25%. It might only be up 17%, but it's there's the downside is protected a lot more than the upside potential. If you ever looked at the he shows the annual results compared to the S&P 500. Um, Here it is. So this is how the market did, and this is how he. No, this is how he did, how the market did. So in his very first year running the fund, there wasn't that much money in there, so he got a good return, 50%, and the market went up 10%. So he crushed the market that year. But you can see that when the market's down 12%, he's only down 3%. And when the market's up 31%, like an amazing year, he's only up 13%. 74 was a bad year. But like 73, you see the market went down 15%. He only went down 2.5%. And in 81, the market's down 5%. He's up 32%. So the year before that, he was up 32.8%. But he did much worse in 1980. Even though he did better in nominal value, because in 80 he went up 32.8, 81 31.8, but he did much better in 81 because you have to compare it to the market. He actually crushed the market, and in this year he matched the market. Been a great stream. Thanks. Catch you later. Have a blessed. Yeah, you too. Thanks for joining. I mean, it doesn't always work out this way, but like 99, he went down 20%. The market went up 21% because he didn't invest in .coms that year. He avoided them. And it worked out because look at the next 3 years. The market was down 9%, 12%, 22%, and he was up 2 of the 3 years. So he kind of caps the downside, also caps the upside. 08 was a rough year, 32%. I guess that was the worst year because he didn't invest in the 1920s. So I'm sure in the 1920s, I think it went down like 80% one year. On a 74 was his worst year, but the market went down 26%. Was that the worst year of the market? 26%? Oh, so it was 2008. 37. I remember that. 37% drop. It's 11. I was gonna get off at 11. Let's do Adobe real fast, and I'll get off. 368, 153. Let's look at the future. Adobe makes like sauces, spicy sauces. to put on like tortillas and things like that. Adobo is this immersion of a food in a stock composed variously of paprika, oregano, salt, garlic, and vinegar to preserve and enhance its flavor. So they sell seasoning for chicken or beef or products of that nature. 11 billion is the projection for 2027. Lot of sauces, seasonings. I think I'm around 418. Adobo. 418. What's the Simply Walled at 610? So I have to question it when I see that's a big jump, but if you have Simply Wall Street, you can click on the data button to see how they came up with 610. And we do a similar type of model, but you can look at, okay, the discount rate 7.7%, and they use a growth rate of 2.8%. That's a pretty high growth rate. Let me match their numbers: 7.7, 2.8. So I'm at 510 if I match their numbers. Obviously, they use different estimates in the future because I'm only estimating 3 years of free cash flow. Then I do my terminal value. They do 10 years. But the risk-free rate has gone up. It was 2.5% for a while. So you can see their free cash flow estimates. It goes from 9 billion to 17.5 billion. So I capped it at 11 billion. So they tend to be a little more aggressive with their estimates, if you've noticed. 34 analysts at 489. Okay, we looked at this already. Adobe, the art program. Right, the art program. Would you call it art program? I think of it as a PDF creator. That's like that's what I think of Adobe. But yeah, they obviously do a lot more than what we're saying. It's good for signing documents. You could sign. Okay, here's their debt levels. That's 6 billion. So equity is twice as much as debt. More cash than debt. So that means they're debt free. No dividend, but lots of buybacks. Buyback yield. I never saw that before. Buyback yield. Because if a company gives a 3% dividend and they don't buy back any stock, people think dividend is everything. But this is actually higher because most companies don't pay a 7.2% dividend. They'll pay like a 1, 2, 3%. So they're buying back 7.2%. That's a pretty good deal. CEO salary is up to 1.5 million. There's been some insider activity, buys and sells, more selling. And their biggest shareholder is Vanguard, almost 10%. BlackRock, those are the two biggest funds in the world. And employee count gone up 12,000 to 30,000, pretty big jump. Yeah, I like Adobe. I think it's a good investment. I like their business model. their scalability factor. Lots of buzzwords. Its flagship product is Creative Cloud. I mainly use Adobe to PDF or edit a PDF. That's how I think. That's how I use it, and I pay a one-time fee for that. The digital experience segment. Okay, looks good. Thanks for joining. Thanks for the donations, and I'll probably see you tomorrow. Okay, talk to you later.